Welcome to It's the Economy. Rating agency CRISIL, in an electrifying recent report, sees India emerge as an upper middle income country by 2031, with a per capita income of $4,500 and overall GDP size of nearly $7 trillion. So what's CRISIL betting on, both in the near term and in the medium term? I have with me the two authors of the report, D.K. Joshi, the Chief Economist, and Miren Lodha, the Director-Research at CRISIL. Gentlemen, thank you very much for joining me. Well, D.K., it's good to hear that 4,500 and upper middle-income country status. But before I come to that, the near term, you have a 6.8% growth forecast for FY25 itself. Reserve Bank is already talking 7%. What makes you a little cautious about next year?
Well, there are three factors which will drive the growth down. It's not a slowdown. 6.8 is a reasonably
damn good number,
I think, from what's happening globally. One is the interest rate hikes. RBI raises interest rates to bring inflation down, and before inflation comes down, they bring growth down. So that is the route. Yes. And we've already seen transmission improving over the last couple of months. The second reason is the fiscal impulse, which is the fiscal deficit is lower as a percentage of GDP. So the fiscal push is somewhat lower than what it was last year. And the third reason is more technical in nature, which is the net taxes. You got an unusual lift this year, which is unlikely to play out in the coming fiscal year. So combine all these three things, you get a mild moderation in growth, I would say.
Yeah, absolutely. But let me just persist. You know, last year, RBI began with 6.5, and all of you were closer to 6. But RBI itself has scaled it up to 7.6. What are the chances of, an upside surprise in the current year as well? Actually, the same thing has happened in the US. They also have faced upside surprises.
Yeah, there is always a chance of upside. I think the upside could come from agriculture because you've got a very anemic growth of 0.7%, and you will get a pretty high rate of growth if the monsoons are normal. So that could be one upside. The second upside can come from the performance of the US economy. I think, don't forget, it's our largest trading partner. We export hell of a lot of goods and services both. So that is a positive development for us. So there are some and if the private capex becomes stronger, I think, particularly post-elections, I think that will also help. So there are reasons to believe that there can be an upside, but we are going by what we believe is the base case.
Okay. No, actually, on that point, let me get to Miren. Miren, before I ask you about the private capex picking up, how will corporate India's revenues grow? Is it going to be a good year of growth? Will you have margin advantage? How commodity prices, we are told, are going to fall. Are going to be, on the back foot next year.
Yeah. See, I think financial performance, we are expecting one more strong year. On, revenues, we are possibly expecting 100 bips higher growth compared to fiscal 24. So we'll touch the double-digit territory. So we're expecting somewhere close to 10% revenue growth for corporate India. Okay. On the margin front, we're expecting a higher improvement, closer to 100-150 basis points.
Okay. So that means earnings growth will be very good.
Yes.
Okay. Yes. It should be.
We look at EBITDA margins, but yeah, I think given that the deleveraging has happened, I see a lot of it flowing to the net level as well.
Okay. Well, let me come to the more important question of capex. Until now, the government capex has done most of the heavy lifting.
Yeah.
Are you already seeing signs of private capex, and how may it do in 25?
So at least in the conventional sectors, which is the traditional sectors where we had a large manufacturing presence, we've seen that pick up. Last couple of years, I think the private capex would have grown around 10-12%, which is a good number. But more importantly, I think next 4-5 years, we're seeing a huge leap up. So from roughly around, currently we do around 3.9 lakh crores per annum on an average. We're expecting the bump up to be around 6.5 lakh crore rupees. A lot of this would be driven by the emerging or the new age sectors where traditionally we've had very little or negligible presence.
EV, semiconductor types?
Yes, the 3 E's, that's what we call them.
Which is?
Electronics value chain, which includes semiconductors. The second is your EVs. which includes batteries, and the third is energy transition, largely the solar PV modules.
Okay, fair. Good to hear that. But DK, how worried would you be about consumption? I mean, capex has done well, government capex has done well, and as Miren says, there's a very good chance that you will also see private capex pick up. But if consumption in the current year at 3.5 continues that way, will investments come? I mean, ultimately they respond to consumption, don't they?
Well, I think I would be worried about consumption, because if you take a historical view, I think back in the 50s, 60s, consumption used to be a very large part of GDP. And then I think it started coming down because investments started improving as a percentage of GDP. And we saw stability in consumption to GDP ratio. So this year it's actually very anemic growth. But I would say that it can still be revised, because this is obtained as a residual, and I think there's always a chance of improvement.
Higher.
And I think maybe it's also possible that the newer types of consumption, because your base is so old, you're not able to capture that. That's also a possibility. But I think the consumption has been a mixed bag. I mean, where we can track, it's very clearly visible that the higher end of items, whether it's houses or it is automobiles, etc., their consumption is rising. I think what we don't know much about is the lower strata, I think. So
FMCG companies tell us that volumes are as low as 2 and 4%.
See, India is a domestic demand-driven economy. I think consumption is its bulwark, 57% of GDP. So I think the consumption story has to continue. And my sense is it's going to continue, because if per capita incomes rise, you will see consumption again increase.
Okay. Okay.
I just have a point to add there. So even in the consumption narrative, I think there's a split that we're seeing. So one is the premium goods, the demand is pretty good.
Yes.
Whereas in
premium homes.
Whereas in mass market, large scale consumption goods, you're seeing actually a flat or a declining trajectory. So there are two divergent trends playing out there.
Okay. No, that's a fair point. Now for the medium term, you're forecasting a 6.7% growth up until 2031. Okay, CAGR. Now, we've never had a long period of growth. We do 7-8% like we did between 2004 and 2008, and then we get one bad year. Likewise, in the next decade, we didn't have such a long stint of high 7% plus growth. What makes you confident now?
Well, I think, first of all, I want to make a point that we have a track history of high growth. I mean, it's not that. For the 3 decades before the pandemic, average growth is 6.2%. It's reasonably high. It's not like China, but it's reasonably high. And now I think what's happening is that you have two drivers of growth coming in. I think one is clearly the balance sheet strength, which whether it is the banks or it is the corporates, that allows you to enter into an investment cycle. The second, I think, as Miren was saying, I think government has been investing. I think they will continue with their investments, but not at this pace. But the private sector has to now chip in, and we're seeing some signs, as he was also mentioning. So we see capex driving growth. So capex cycle hasn't picked up for a long time, and now it's been on an upturn for the last 3 years. So I see a lot of potential for it to go up further. So that is one. Second is the efficiency. You're creating infrastructure, and physical and digital. Connectivity is improving, turnaround times are are shorter, so you have enough data to show that. And digital infrastructure is allowing a lot of efficiency gains in terms of payment systems. It's also allowing, I think the government is saving money when it transfers money to poor through direct benefit transfers, and it's also a platform for innovations. I think all these applications like CoWIN, etc., they all erupted because of that. So I think that itself is helping. Now, I don't remember any other country developing its physical infrastructure and digital infrastructure at the same time, I think simultaneously. So there are synergies that are possible out of this, and we are already seeing that. A very rough example is that the roads. You've constructed roads, and now you've also GST via GST.
FASTag.
Yeah, FASTag. You've eliminated the octroi. Now this time that you spent on the toll is much lower. So you're saving energy. So now you add these up across the nation. I think so this is only one example. And through smart metering, you are also saving your electricity leakage. I mean, leakages are much less. So I think the digital and physical Synergy will also allow you to grow faster, because I think there are three drivers of growth: capital, labor, and efficiency. So what if efficiency is going up, it means that with the same amount of capital and same amount of labor, you are able to grow faster. And here I think the sad part is that labor doesn't contribute much to growth in India, but that's a different story. But capital, we are clearly seeing it contributing more now, because you are creating capital which also spills over to the private sector, which is when you build road, there is more opportunity for the private sector to come forward. You'll sell more cars. I think the efficiency, logistics will improve. All those are visible. So it's moving in the right direction. So I think confluence of these things is making us believe that we can
have a consistent record of
6.7% for at least till the end of this decade. I think that's how far we can see as of now.
Fair point. Miren, I want to ask you, what do you see as advantages because of the lower yields? I mean, we've just got news that India is getting included in the Bloomberg Emerging Market Index as well. It's not a great deal of money. It's only $3 billion, perhaps, or $4 billion. But the point is yields. I mean, how do you see that shape up with bond index and fiscal prudence coming in? And will that be a big accelerator for investment?
Yeah. So I think more than an accelerator, I think it's an enabler. So, we don't see a constraint, at least on the funding side. That's how I would like to see that. Both from a banking perspective and a bond market perspective, I think there'll be enough support to ensure the private sector has access to investments which they require. If you look at the emerging sectors, a lot of the borrowing would be by the larger corporates, which could be in the nature of bonds. So there'll be disintermediation there. Rather than borrowing through banks, they would directly access the bond markets, which is where I think what you asked, the yields will definitely play out and will support. But again, a small improvement in yields will not necessarily determine the investment decision, correct? It's the other way around. But there's enough support to ensure.
Financial support is there for capex plans.
Yeah.
But let me, now running out of time, what do you think can go wrong? Where are the red flags?
For the growth?
Yeah,
I think
for the excellent growth story that you
One is that I think we've seen resilience to global shocks. And I think if the global shocks increase, we are very, very vulnerable to oil. I mean, if oil, so that is one external risk which we can't avoid. I mean, we are too dependent on oil. The second, I think, could be, I think it's generally speaking, complacency. I mean, you're doing well, you'll do well. You need to accelerate that, keep the pedal on the reform side so that you are able to grow faster, I think. I think these are the two risks that I see. Weather is always a risk. Climate is always a risk. And I think no target comes without risks. So
yes, absolutely.
A lot of these shocks could actually emanate from geopolitics. So that's what we need to keep in mind.
That's a fair point. Yours is an excellent 75-page report, and I have not been able to do justice to a lot of sub-themes. Miren, why don't you tell our viewers what will be the one or two sub-themes that the report speaks about?
See, one, I think, is the corporate financial performance. It's going to be excellent. I think from a revenue standpoint, we'll have fourth consecutive year of healthy growth, not seen in a decade. Profitability, we hitting almost a decadal high, going back to pre-COVID levels. From a input side, there's easing of commodity prices. Whether you look at crude, we are 34% off the peaks that we've seen recently. Steel, we are almost 25-30% off. So these are some of the
juicy things
yes,
for
yes.
Which you are explaining in your report. I think you have said all the right things for a stock market audience: revenues, margins, cheaper raw material prices. But I take on board, DK, the caution that you are saying that we don't get complacent and we continue to improve what you called ease of doing business, removing the roadblocks, the judicial, legal system. And those kinds of roadblocks to growth. Looks like 7% would never be a given unless we work.
I think don't forget, India is starting from a low base. It has a huge opportunity to improve its growth by doing little things. I mean, which countries like China can't, I mean, they can't increase their investments. They're already at the peak of efficiency. India has a lot of opportunity right now. It's starting from a low base. It can continue to grow faster for long.
Great to hear that as we stand on the threshold of a new financial year. and there are several things coming together. There's an election which promises, both the political and policy stability in the next 5 years. So we are standing at a very interesting inflection point. On that positive note, it's curtains on this edition of It's the Economy. After a break, it'll be time for Chartbusters.
JG Chemicals